The stock that we are going to talk about in this video was once the quote-unquote king of COVID, but now in 2023 the stock's price is below its IPO price, and that's despite the company 13xing its revenue over the last 5 years. So I think this tech stock is an interesting case study, and I think there's a lot that we as investors can learn from this example. And so without further ado, let's have a look. All right, hi there. So as you can see on screen right now, the stock that we are going to talk about today is Zoom Communications, ticker ZM. And Zoom used to be the king of COVID. The company was posting insane growth. We'll get to that in a second. But today, as I said in the introduction, the stock is actually trading at a price that is below its IPO price. So in a way, Zoom is now the fallen king of COVID. And in this video, we'll reveal why. So here's the table of contents. We are going to start by pointing out in what way Zoom Communications was the dominant video chat platform during the COVID era. We'll have a look how the financials developed over those years and how the stock price developed as well. However, we will then take a look at what exactly caused the stock to drop significantly, how exactly the financials have developed more recently, and obviously we'll also have to consider the competitive environment the business is competing in. We'll then have a look at what we as investors can learn from Zoom's stock performance and business performance and how we can avoid making expensive mistakes. And finally, I'll briefly discuss my thoughts on Zoom's current valuation, and I will discuss whether the stock, that again is now trading below its IPO price, is now attractively valued. So let's start with the first chapter, the video dominance of Zoom during the COVID era. So what I've prepared here is first of all that Zoom's stock price actually jumped 80% on the day it started trading publicly. The opening price, as revealed by this Yahoo Finance headline, was $65 per share. And as of today, the stock is actually trading below $60 a share. So what you can see on screen right now is the stock chart of Zoom Communications. And as you can see, ever since opening at a share price of $65 a share, well, the stock actually increased very quickly to $100 a share. It then dropped to around $62 a share. And over a period of less than 12 months, the stock then went insane. It was up 800% over a very short time period. And obviously, this was driven by the COVID-19 pandemic. There was a lot of demand for video communication solutions. Many people had to work from home, and obviously many businesses were not prepared for such an environment. So it only made sense for Zoom's stock to perform very well. What I should say is that it only made sense for the business to do very well. Obviously, Zoom Communications was a major COVID beneficiary, and as the financials improved, it at least theoretically makes sense that the stock price performance will also be quite favorable. This is something that I try to back up by this Morgan Stanley chart, which basically shows that over the long run, the stock price will primarily be driven by revenue growth. Obviously, the development of profit margins will also play a role, but the dominant driver of the long-term performance of a stock is the development of the top line. So with that being said, let's have a look at the top line growth, so the revenue growth of Zoom Communications over the more recent years. So basically, Zoom has been absolutely crushing it. So what you can see here is that ever since 2017, the company was able to 72x its revenue, which is an insane growth rate. I'll get to the annual growth rates of Zoom Communications in just a second. And if we just focus on the period during which Zoom Communications was a publicly traded company, well, the business still did very well. The company was able to 13x its revenue since its IPO, which, as I already said, is incredibly impressive. And this should support a positive development of the stock price as well. What you can see on this slide here is the annual growth of the top line. So what you can see is that in 2019, the business grew its revenue at a rate of 118%, followed by a growth rate of 89%. Then during COVID, in its 21 fiscal year, the company saw revenue growth of 325%, which is super rare for big publicly traded companies. But Zoom Communications, as I explained, due to the very unique macroeconomic circumstances was able to pull it off, then I think it was quite an impressive feat that Zoom was able to actually continue to grow its top line at a rate of 54% in 2022. So during a period during which the company was already lapping the very impressive COVID growth. But more recently, what you can see is that growth has now slowed down. And spoiler alert, obviously, this is one of the main reasons why the stock is now down a significant percentage from its previous high. Yeah, the very good development of the business is also reflected by the cash generation capabilities of Zoom Communications. So what you can see is that during 2 fiscal periods, during 2021 and 2022, the company was able to generate around $1 billion in free cash flow, which again is very impressive. However, this brings us to chapter number 2. In a way, the insane success story of Zoom Communications was at some point destined to end, and the business was facing the harsh reality of capitalism. So the stock is actually down 90% from its previous peak. As I said, it's now trading below $60 a share. And you might be wondering, well, what happened here? We saw this spectacular performance of the business. Why is the business down 90% from the previous peak? I mean, that's an insane share price development. Say you invested $10,000 in Zoom Communications at its peak, you now have $1,000. That's quite a horrible outcome for any investor. It will be hard to have other positions in your portfolio that can actually make up for such a poor performance. So what happened? In a previous video of mine, I was actually outlining or highlighting a framework of how you can actually think about the business development of COVID beneficiaries during the COVID era and how the business could potentially develop in the period following COVID-19. So I was basically coming up with 4 different scenarios. One trajectory that I highlighted here is maybe the most favorable one. Basically, some COVID beneficiaries saw accelerated growth during the COVID era, and then they continued to grow at a growth rate that they posted before COVID, but just at an elevated level. Then the second trajectory would see growth temporarily slowing down, but it would then also continue to grow at a rate that the business grew at before the pandemic. Then trajectory number 4 is not so favorable. We saw accelerated growth during the pandemic, but then those businesses, when they had to lap those spectacular years, saw negative growth and only slowly recovered to return to the trend growth level. And then the last trajectory, and I think this is basically the pattern that Zoom very likely is following right now, is we saw excellent growth rates during the COVID pandemic, but then growth slowed. And as the company, and Zoom specifically, and that's true for other businesses too, was able to capture such a significant chunk of the overall market, the growth going forward is likely going to be much slower. Yeah, and I already hinted at the fact that I think that's true for Zoom, and it's also reflected in the financials of Zoom Communications. So what you can see here is the quarterly development of revenue on a last 12-month basis, and you can basically see a perfect curve. So the curve I'm talking about here is the black line, which reflects the year-over-year growth rates. We see the incredible growth during the COVID pandemic that I just hinted at, so triple-digit revenue growth. But then ever since the peak in early 2021, growth has slowed considerably. Basically, it's going downhill ever since, and we have basically arrived at single-digit growth in 2023, and in the most recent quarter, Zoom actually only posted growth of around 4%, which adjusted for inflation basically means the company isn't growing at all, at least in real terms. The most recent fiscal year, the development over the last 12 months also poses a different question. How profitable is Zoom really? Of course, one big problem that Zoom Communications is having is stock-based compensation. So adjusted for stock-based compensation, the company was actually not profitable during 2023. And personally, I have a hard time assessing how profitable Zoom video communications going forward is actually going to be. I think $1 billion in free cash flow profits going forward is probably not all too likely. All right, so what can we learn from the development of the business of Zoom and the stock, and how can we avoid making an investment in Zoom video communications at one of these elevated prices that would then have turned or resulted in those horrible returns for investors? So I think there are 3. And the first one is that as an investor, I think it's incredibly important to be as rational as possible. What I tell my clients in my mentoring program is that the more robotic they can be in their processes and in the way they stick to their processes, the better they are likely going to do in the stock market. So on the next slide here, I've basically shown you what pattern the psychology of investors usually follows. And we can see that when prices are developing favorably, when the overall business environment is positive, when there are no major macroeconomic headwinds, well, then it's easy to be bullish on stocks and to be willing to pay very high prices for some stocks. And that's why actually when the perceived risk by investors is actually the lowest, the actual risk is usually the highest. And I think that's absolutely what we were seeing during the pandemic. I've talked about this in previous videos, basically where we were in a so-called everything bubble. The prices of all sorts of assets, so be it real estate, cryptocurrencies, gold, stocks, they all went up regardless of the development of the underlying assets, or I should say that some assets like cryptocurrencies obviously have no underlying fundamentals. But if we focus on stocks specifically, prices were going through the roof. We had the meme stocks, and investors were basically willing to pay all sorts of prices for businesses, regardless of the true intrinsic value of those businesses. And I think that's true for Zoom as well. So investors were willing to pay double-digit revenue multiples for the business, which usually is not a very good idea. And what I will say is, to defend some of the investors that were making investments at elevated prices, is that back then it was kind of considered normal. Everyone was talking about compounding stocks. Obviously, Zoom as a business was doing very well. As I said, we saw revenue growth of 300%. And obviously, if the business could continue to grow at such rates, no price would be too high, basically. But obviously, no business can grow at a rate of 300% forever. And as we can see, Zoom was only able to do it in one single year. And as I said, I think the fact that they were able to continue growing in the year after that was already very impressive. However, this brings me to a second learning that I think you have to internalize, and that's that modes matter. So what do I mean by that? I think businesses need to have competitive advantages, or otherwise they will see their revenue growth slow, because obviously high growth and high returns will attract competition. Yeah, and I think that's absolutely true for Zoom communication as well. So I have never invested in Zoom, and even during the spectacular performance of the stock, I was obviously looking at it like I thought it's a very interesting business. But even back then, I still thought, well, what's the company's mode? Well, there is some brand recognition, of course, but are people really willing to pay more for a Zoom communications video service just because of the brand? No. Well, then does the company have switching costs? Maybe some, but I would argue that there are basically no switching costs. It's very easy to cancel your subscription and just to go with another video communication service provider. Does the company have patents? No. Does the company have cost advantages? Possibly, but then again, I don't think that's really a mode for Zoom communications. So I think one big problem of Zoom video communications is actually the lack of a competitive advantage. The service they are providing is not mission critical for most businesses. It was maybe during the COVID pandemic, when also alternative offerings weren't of similar quality. But taking all of this together, I don't think Zoom video communications has a lot of pricing power. I think if they would double their prices tomorrow, a lot of people would actually switch. So yeah, nowadays, if you talk to people, I think many people actually, or I should say many businesses in particular, are using Microsoft Teams. And if you talk to people, I think most people will point out that they are not particularly happy with Microsoft Teams. And many people actually argue that Zoom video communication has the best video chat product. However, I think it's very hard to compete with Microsoft in the workflow/productivity category, because obviously Microsoft has a mode. They have this significant bundle that makes the Microsoft offering very compelling to all of its users. So they have a video chat solution, but they bundle it with all of the other solutions and Office services and software products that I basically display at the bottom of this slide. And obviously Microsoft also has its distribution network, which is also quite valuable and which makes it very hard for anyone to compete with them. So the learning here is, if you have no moat, just being a little better than your competitors is not enough. So a business, especially in the software world, better has some switching costs. So here's a tweet from Buku Capital. He wrote, "I guess what I mean is the best second products develop somewhat organically as you listen to your customers and evaluate adjacent market opportunities and so on and so forth. And they just had to try to speedrun the whole thing." So what he's referring to is that obviously the COVID pandemic accelerated a lot of developments, and Zoom obviously had the challenge to develop, as Buku Capital writes here, to develop more services that can go along with their video chat servers that would then make the product they are offering and the service more sticky. So on the next slide, I've actually decided to show you what is actually included in some of their offerings. So nowadays they also offer a calendar feature, they offer mail services, they have cloud storage. But then again, I don't think taking all of this together, this makes the Zoom video service all too sticky. Like I can tell you right now, for example, I am a Zoom user, I'm a paid user, I actually use it in my mentoring program, and I think when it comes to the video chat service, they have the best in class product. But if they would double their prices tomorrow, I would probably very seriously consider switching to one competitor that simply offers a similar service of almost equal quality at a lower price. So again, I don't think their service is super sticky, which is different if you look at other businesses. So just one company that I've talked about previously on this channel and which I hold in my portfolio is Wix.com, which is basically a website builder. We'll simplify the business model here. But I think once you have set up a website, which usually takes a lot of time, you're not going to switch. You're not going to rebuild this on another platform. I mean, some people will, but it will be very painful and also costly in terms of the time commitment that is required. And that's probably even more true for other software solutions like CRM systems. And I'm sure you can come up with other examples here too. So overall, I think the lack of a moat was the major problem of Zoom, which has led to the relatively poor business performance in the more recent month. All right, so the last lesson to learn from Zoom communications here is that it's very hard to not see reversion to the mean dynamics. And what do I mean by that? Well, here's one tweet that I shared on Twitter. I wrote a creed in reference to a previous post. I think over-projecting growth, so looking at past growth rates and just assuming that high growth will continue forever or for a couple of more years, can be very dangerous. So over-projecting growth and underestimating reversion to the mean dynamics can cost investors dearly. So I think very few business can actually continue growing at high rates for a long period of time, and I'll get back to that in just a second. So I was trying to visualize it here. So usually what the development of businesses look like, and there are actually academic studies that support this, but I was just basically drawing a sketch myself here, is if they see very high growth right now, it's very likely that going forward they are going to see that growth slowing down. And usually this slowdown happens very quickly. So in year 3 or 4, the growth rate might have already been cut in half. And then eventually they will continue to grow at a usual market average rate. And for Zoom communications in particular, this development, the slowdown of growth, might have been, obviously I have no crystal ball and I can tell you what the growth going forward will look like. But to me, it seems like the COVID pandemic was able to pull forward so much of demand for Zoom video communication. So demand that they, under normal circumstances, would have only been able to capture over a period of, say, a decade. Well, they pulled it forward so quickly that basically, I think Zoom video communications might only grow at a very average growth rate going forward. And I wrote here that they were basically speedrunning the business cycle. This is what I just talked about. Here you can basically see a cheat sheet of what the business cycle of most businesses look like. And probably, again, I don't have a crystal ball, but I think Zoom has now reached the maturity stage of the business stage life cycle, which means the business will see slower growth and will focus a little more on optimizing its profitability. Yeah, and just to finish this is a table that I have shown you in previous videos already. Basically, we are looking at numbers that Chris Meyer shared in his book 100 Bagger, and we can see that very few companies can actually continue to grow at a rate of 20% or more for multiple years. So of 2,200 businesses who were able to grow at a rate of 20% a year in year one, only 3 were able to keep up this growth for 3 years. And I think it's very important to keep this in mind when you are trying to value businesses by projecting forward growth. So to wrap it up, is Zoom Communications currently undervalued? What I'm not going to do here is I'm not going to share like a very complex valuation model, but the way I think about it is, so over the last 12 months, Zoom Video Communications generated revenue of around $4.4 billion. Now, I would probably pass right here because I don't have a strong opinion on where the profitability of the business will end up. Will it be 20%? Like historically, in some periods or during some periods, Zoom Video Communications was able to generate 20% operating margins. Personally, I have my doubts. Obviously, Zoom Video Communications is a very asset-light business. It's a software business that can probably generate quite attractive margins. But then again, as we said, they are basically offering a commodity service. They might actually come under pressure because of competing services that are of similar quality. They might have to lower prices actually, which would obviously be a major headwind for the development of margins. And as we also showed, more recently, the business was actually not profitable on a free cash flow basis once you factor in stock-based compensation. I think stock-based compensation at Zoom Communications in particular is kind of out of control. So over the last 12 months, stock-based compensation was basically around 25% of total revenue. So that's quite significant. But if we just go back to the profitability of the business, so I just said 4.4 billion in revenue. Let's assume the business can only generate profit margins of around 10%. This would lead to profits of around 400 million in operating profit or free cash flow, considering that the company is now trading at a market cap of, I think, around $17 billion and an enterprise value of $12 billion. Well, that would translate into a 30 times multiple, which I think is still relatively expensive. So personally, I don't think the business is attractively valued. Obviously, if the business can re-accelerate growth, if it can actually continue generating 1 billion in free cash flow in some years, the valuation might look much more compelling, but I definitely lack the certainty whether those outcomes are actually very likely. Yeah, and with that being said, I'll wrap it up here. I hope you enjoyed the video. Let me know in the comments what you think about Zoom Video Communications, whether it's attractively valued right now or not, and I'll see you in future videos. Take care.